This video is a simple guide on how to find your daily buyers using the smart money concept. Everything I'm going to show you in this particular tutorial can be applied to the forex market, to the crypto market, and even the stocks market. So I have my chart right here and a list of things you must check every day you want to find your daily buyers. So let's get into the video and I'm going to show you everything. We're going to check everything right here and the reasons why we are looking out for this checklist before we can get our daily buyers. So the first thing is to check for previous liquidity grab, which we can visibly see at this point. This was the most recent that happened. Liquidity was grabbed below this level. Why are we doing that? This is because every time the institutions grab liquidity at some point, they deliver it to the next side of the market. So if liquidity is grabbed at this level, this area, we expect to see it being delivered to the upside. And if it is grabbed at this area, we expect it to see being delivered to the downside. So this is the reason why we look out for this. And the most recent is obviously this one. So the next thing to do after that is to check for your market structure, which includes swing highs and swing lows and relative equal highs and lows. So what we are seeing right here is absolutely our swing lows. What we are seeing here, can you see these ones? All these levels, all these levels, all these levels. So this is more visible to us because we are seeing where all the buy side liquidity is residing now. So all this level we've mapped out is where the buy side liquidity is residing. And if price is moving, it is definitely going to grab all this liquidity, okay, on the buy side, just like it grabbed all the ones on the sell side. You see below highs and lows, that is where liquidity resides. So after doing that, the next is to actually check whether we are in a premium or in a discount. So I'm jumping to number 5 so that I can reduce the work for us. So if we take our Fibonacci tool and take this area, can you see, and place it to the end, swing high and this swing low at this point. So what we are seeing right here, the middle, from the middle down is where our discount level is, and the upside is where we find our premium. So we are currently at a discount level, so we expect price to deliver liquidity to the premium level. I'm taking this gradually so you can get everything properly. So after knowing this, the next thing to check for is this change of character, break of structure, or market structure shift, and that includes the most recent one. So what we are seeing right here, after this lower high, lower low, lower high, there is no any lower low again because price just came here and changed direction. So from here we had a change of character at this point. So this is exactly where price actually changed direction completely. We are no longer in a downtrend. This is a downtrend. The last lower high was this and the lower low was obviously this one. The lower high was this. There is no lower low. So this from here, after changing direction, after taking this lower high, we can confidently say that we are no longer in a downtrend but rather an uptrend. So from here we know that our trend is an uptrend from the daily time frame. The next thing to do is to check for an institutional reference point, either a fair value gap, an order block, or a liquidity void. This is very important because that is obviously where price may be reaching out. If you watched my video on the 2 types of liquidity, which is on my YouTube channel, you're going to get exactly the perfect way to do this because there are 2 types of liquidity: external range liquidity and internal range liquidity. External range liquidity resides around all highs, all lows, and relative equal highs and lows. So what we saw here is a grab on external range liquidity. So what we expect to see is retracement back to an internal range liquidity. And the one we are seeing here, let me show you what happened from here. There is an order block at this point. This particular one is an order block. This level I just mapped out is an order block. So there is a fair value gap here. Can you see this fair value gap? This is a fair value gap. This is a higher high. This is a higher low. So price actually retraced. Let me just expand it so you can see what I'm saying. So what we saw right here, it is just price retracing back to this area to make it more clearer so you can see. After this formation, price pushed higher high, higher low. The retracement reached out to liquidity below this low. There is, you can see, if you can see this liquidity below this level. Okay, so liquidity was grabbed trying to take it up, and the liquidity grabbed here in form of an internal range liquidity. We have a fair value gap, this level in between this candle and this candle, the low of this candle and the high of this candle. So liquidity was grabbed and we are heading up. So we have no business with this place as it is now. So we look out for the recent one again. So what is the recent institutional reference point we are seeing? Is this order block. Can you see this candle? This order block. So if price is retracing, we are actually seeing price coming to that institutional reference point, because after an external range liquidity is grabbed in form of an old high, this old high was grabbed, we expect price to come back and then push. The ultimate goal is to actually grab liquidity above this level, the buy side liquidity, but it must keep taking external range liquidity and internal range liquidity. And then if you look closely, look at this, there is a very small fair value gap at this area, a very small fair value gap at this point. If you can look very closely, a very small fair value gap at that area. So price may probably retrace and test and pick liquidity in this internal range level, an order block, and there is a fair value gap, either one of these. So how do we get the proper bias now? We will now drop to 1 hour time frame to check what is happening there, so we can get it properly. So if we drop down to the 1 hour time frame, this is what we're going to see. So from the 1 hour time frame, can you look at what is happening here? Can you see what is happening from the 1 hour time frame? So if you're coming to trade on that day, this is absolutely what you're going to see. So you start from the daily time frame and come here. So what you see here from this level, this is where the higher time frame liquidity level is residing. You can see this is the sell side liquidity in this regard, liquidity residing below this level. And we had a break of structure here, break of structure, and currently we are at this level. So what we expect price to do is to come back to an internal range liquidity. After an external range liquidity is grabbed, we expect price to come back to an internal range liquidity. Please watch that my video and learn about the difference between an external range liquidity and internal range liquidity. Those are the major things you need to know. After liquidity is grabbed in form of an external range liquidity, it comes back to an internal range liquidity, which we expect to see a retracement. It can be this particular fair value gap. Let me show you. I actually showed you which of those one, or this fair value gap. You just map your levels, and then the lower time frame will give you which of those ones is more important. Can you see all these ones are fair value gap? I'm just trying to map it out for you. All this area is fair value gap, but which of these fair value gap do you think price will work with? So to get that properly, you can take your Fibonacci tool, place it from the recent swing high, from this level, swing low and swing high rather, to that area. So if you place your Fibonacci tool, you are going to see that below this level, any institutional reference point below this area, it is the most interesting one. Below this relatively equal lows, all this area is where your internal range liquidity is residing. So if price is obviously coming down, it is going to come to a discount level before taking up again. So this is where your knowledge of getting proper understanding of your institutional reference points comes into play. Let me delete everything from here. Okay, so look at this. We know that from this area down is where our discount is, and look at this fair value gap at this area. It may be this area, it may be lower than this area. Price may even reach out for liquidity below this level. So that is why you need the lower time frame, such as 15-minute time frame and the 5-minute time frame. So at any point price comes down, pushes lower and lower and lower, the retracement is going to be a downtrend. Remember, you expect it to come like this. At this area where your discount is, below that 50% level, above it is premium. Where your discount is where you start preparing to go long again. So for you to get the proper place, you must go down to a lower time frame. This is 1 hour time frame. Go down to 15-minute time frame and watch out for a break of structure again. That is shift in market structure. Like this is the last recent high. If we see anything that react like this at such areas, this is a fair value gap. We expect price to come. By the way, this is even an institutional order flow entry drill. I will teach you about that. Institutional order flow, IOFED entry drill. This is type 2. So what you are seeing right here, this may probably bounce around this fair value gap. The confluence of this and this, when you see a fair value gap that has a recent high, it is what we call an institutional order flow entry drill. So we expect price to react around this level. So these are the areas you can obviously and confidently take trades. When you see such kind of thing happen in the lower time frame, you must have it. You must wait for it to align with the overall trend. It comes down, take out the last high just like we've seen there, and then you can take your trade at such kind of area and confidently say that your daily bias is actually bullish, and make sure that your stop loss is below here. If you can minimize your risk to this area below this place, because liquidity is residing below this relatively equal low. So I hope this short video is able to open your eyes on how to do your daily bias analysis. You want to learn more, make sure you subscribe to my channel and get more and more. If you have any question, I will be there to answer you. You can apply this literally on cryptos, on forex pairs, on stocks market, anything you're trading. Thank you guys for watching. See you next time.